Welcome to our webinar. So today we've got myself, Phil Thompson, Director and Financial Advisor at Skywealth, and joined with me, we've got Trent Bacon, who's one of our advisors, Head of Advice Creation. So we're talking about understanding personal insurance, so expert insights, pitfalls, and live case study. So quick disclaimer, this is all general information. Anything we talk about today, we're not giving you personal financial advice. Don't come and sue us if we say the wrong thing. Don't go and follow our advice without getting personal financial advice. So we'll talk about the agenda. So as I said, Trent and myself, we're going to be talking about different areas of the presentation. But the agenda, we're going to be talking about understanding what are the different policy types, how do they work, assessing your insurance needs, tips for choosing the right cover with the right insurer, when should you review your insurance, most common claims, not that we see, but statistically, what are the most common claims? We'll talk about pitfalls to avoid, comparisons, inside, outside of super, group versus retail policies, common misconceptions. We will talk about loadings, exclusions, how do they work, and we've got live case studies, and then a Q&A. If you've got any questions throughout this presentation, just jot it down in the question section. No, just in the chat function.
Yeah,
find the function wherever you are. Ask your questions all throughout, and then we may try and address it immediately. If we're talking about it, we may leave them all to the end. We'll see how we feel. So to kick us off, Trent, help us understand what is personal insurance, different policy types, and the cover.
Awesome. So there are 4 types of insurance that we typically work with, or 5, sorry, that we will typically work with for our clients' needs. They're all listed above or on your screen. So life or death cover, total and permanent disablement, often called TPD, which we don't really like abbreviations. That's one that we'll often use. Trauma cover, income protection, and then we've also got child trauma for your little ones as well. So what do each of those things cover? We've got a few slides on those. So our first one is our life cover. Pays out a lump sum amount of money if you were to die or be diagnosed with terminally ill. So for the most part, it's have you passed away? All right, let's get the death certificate for a claim and sending that off to the insurance company or the super fund, whoever your insurance is with. Are usually a relatively straightforward process. Our next one is our total and permanent disablement, or our TPD. This one also pays out a lump sum amount of money. And this is if you would become total and permanently disabled, or in other words, are you unable to go to work ever again? So depending on the different definitions between whether your policy is in super, outside super, or if you're working at the time, it could be a wide range of things. But thinking if you could not go back and work in a job, you're getting a lump sum amount of money paid out. The next one is our income protection. So this one pays you out a monthly benefit if you're unable to work in the short term or the long term. So if you're permanent disablement, it's paying you out that once-off payment. Once you're never able to work again, the income protection is paying you that monthly benefit, even if you were to be able to get back to work. So thinking short-term injuries, or it'll also pay you out if you're never able to get work again. It will continue paying that monthly benefit as well. So typically what we're seeing at the moment is income protection will be limited to a maximum of 70% of what you're earning. Each of the insurance policy also has a waiting period. So you'd have to be unable to work for a certain period of time before your income protection starts paying you out. So it's not, I'm unable to work today and I get paid out tomorrow or the next day, and then, all right, I'm able to work next week. So it's not your typical illness, or say COVID, where you're off for a week or two. Usually your illness has to be a longer period of time. For most part, it's 30 days. It can be extended out, which will dictates what your premium looks like. There also is benefit periods. So we can choose that as well. Most common ones are 2 years, 5 years, or through to age 65. It's basically how long do you want to get paid for if you're unable to work. Our trauma policies, so this one pays you out on the diagnosis of serious illness. Each insurer has about 30 to 40 different illnesses they cover, and they do differ a little bit, but the main ones that are most likely to be claimed on are cancers, heart attacks, and strokes. And again, that's going to pay you a once-off lump sum benefit as well. And then our child trauma, so very similar to an adult trauma policy, will covers your children, making sure if they have a major illness or if they pass away, we've got a lump sum amount of money to cover all sorts of different needs that you'll face if that was to happen. So what do we use the personal insurance for? So it's looking beyond just your medical costs, making sure that if there are certain things that your family firstly relies on, or other dependents rely on, we're covering that. So if you're looking at your income, if you're unable to work, your income is looking at covering your bills, your living expenses, and all your family. So if you're unable to work, we want to make sure that we're covering the majority of that through your income protection. Similar sort of thing with your permanent disablement. If you're never able to work again, you've got to have those long-term bills that are popping up. And if you pass away, you're looking at, all right, if you have children, your partner's now a single parent, what sort of things are going to pop up there, and looking at it that way. Similar with our trauma covers as well. What are those instant needs that are going to pop up if you were to have major illnesses? I'll pass it back to Phil to go through the assessment of our insurance needs and how we do it at Sky.
Awesome. So, when it comes to assessing your need for insurance, over all those different types of policies, the way we think about it is a lot of people think, if I can just have enough money to cover the debt. And the reason being is because that's the biggest expense in most people's lives if they've got a mortgage. So they think, if we can just clear that debt, then we'd be okay financially. But the way we think about it is actually much more holistically, because at the end of the day, although the mortgage is really large, however big it is, it's going to be a big expense to your, household budget, especially with interest rates going up. We don't just think about covering the debt. So that is a big thing. So making sure we're covering the debt, and the way we think about it is the home loan. So the house you're living in, we cover that. But also the loss of income. That's actually the biggest one. Is if you pass away, unable to work, it's actually that loss of income that is the biggest factor. So even if you've got a really high mortgage that that's costing you 30, 40, 50% of your income as a household, you're still missing the other 50% or 60, 70%. And so we look at, what is that lost income going to be for any of these kind of concerns. We also look at medical costs. So are there going to be some medical costs? Now, we never know what's going to be claimed on. We don't know if it's going to be, a sore back and you can't go to work for 3 months. We don't know if it's going to be cancer and you're out of work for multiple years. And so we factor in some money towards medical expenses. Even if we are using the public system, we want to use, we'll talk about it when we come to claims. There are some out-of-pocket medical costs. And debt, as we talked about. So we generally don't look at car loans unless they're significant. We generally don't consider investment property loans unless our clients want us to consider that. Because my philosophy is that if I was to pass away and I've got investment properties, I've got the ability to sell that and pay down that debt if I choose to, or retain it if I choose to. We want to think of, what is your partner going to do with their work? Are they going to take any time off? Do you have any children? So do we need to replace income if I pass away? I've got 3 young kids and my wife's currently not working. So if I pass away, well, because we've got 3 young kids, there's money required for that loss of income. And also tax. Are there going to be any tax? So on life insurance, if you've got financial dependents, generally no tax on that, but TBD, there may be some tax. So we want to factor that into the level of cover. Now, as you can kind of tell with a lot of those different things, it's different for every individual. So if you've got a mortgage of $1 million versus someone with a mortgage of $300,000, well, the level of cover will need to adjust accordingly. And same with the income. If that loss of income is $300,000 that we're losing, then that's going to be a greater need for cover or level of cover than if we're losing an income of $40,000. And even if I do say loss of income, but if there's a non-working partner, there's also the cost of care for the kids as well. So there are a whole bunch of things to factor in when it comes to the level of cover, but that's kind of one of the a little bit more art versus science when it comes to insurance, because one person, the 2 individuals in this exact same scenario may desire different levels of cover. One wants a lot more cover and the other one wants a bit less. So it is really a balance between cost and level of cover that we discuss with kind of our clients. All
right, so we've got the tips for choosing our right insurance policy next. There's multiple things that go into it, and this is the crux of why you would reach out to an advisor like Sky or anyone else to do your insurance advice. So the 6 things that we typically will look at, the first one being our main one, which is our pre-existing health conditions. So what we do is we ask for all your existing health so that we can figure out which insurance policy is going to be the best one for you in terms of which provider. So there's about 10 or so different providers in Australia that are insurance companies, and multiple different super funds out there as well that provide insurance as well. So each insurer has different views on different health events. So I'm looking at a client that we looked at previously for a wide range of different health events that have popped up. And we've gone out and what we call pre-assess. So ask the insurance company, these are our health events. What do you think you're likely to offer? So that the client doesn't need to go and apply for these covers. We can do it at the start and say, this is the insurance company we think you need to be with. So when I'm looking at it, there's 4 insurance companies said they would just flat out not accept permanent disablement income protection because of different health events. There was 2 insurance companies that were happy with having the income protection and permanent disablement, and all insurance companies were looking at the life and the trauma policies as well as being standard rates, so having no issues with that. The difference between the two insurances, one of the insurers were looking at putting a loading, so making their client pay more for one of the insurances, where the other insurance company was looking at an exclusion for 2 of them, which was exactly the same as the previous insurers as well. So basically, we went and saw the 10 different insurers. We were able to cut it down to 2 pretty quickly, and then there was one that was likely to be the one that we're more likely to go with, and we're able to pin it down to 2, rather than a client going, all right, I want to go with XYZ insurer, applying for it, getting them declined, then we go to the next one and reapply for that one and keep doing that same process, which can often take a month at a time to do an application. So we're able to shorten that process for you and make sure that you're getting the right insurance as well. The other one is our family history of health, which is tied into our pre-existing health as well. So your family history will affect if you're able to get insurances as well. It's less strenuous than your own pre-existing conditions, but there are certain things. Next one, whether you're in a really high risk occupation like a police officer, or a low risk occupation like mine where I sit in front of a computer all day, that's going to affect how much your insurance is going to cost, and again, which insurers are likely to offer you cover. Your age, that will affect how much premiums are going, because typically when you're younger, you're less likely to claim on your insurances. The older you get, the more likely things are going to happen to you, so the premiums go up. And as Phil spoke about, the level of cover, the more cover you take out, typically the more expensive it's going to be, all factoring in the previous things we've spoken about as well. And then our length of time that you're likely to need it. So there are what we call 2 types of premiums. There are stepped and level. For insurances that we need for longer, we'll typically recommend that you hold a premium that you pay more for, but it won't increase over time. And the other one is our step premiums, which you pay less for at the start, but as you get older and more likely to cover, those premiums become more expensive. So for insurances we don't think you need for as long as the level premium, we'll often recommend stepped. And again, comes down to your overall need and what your client picture looks like, because everyone's different.
All right. When should you review your insurance? So we've got a few questions already, which are really good. We're going to actually address some of those questions in the presentation. So if you're watching and you got questions, just chuck them in and I'll let you know if we're going to address them in the preso or at the end. So when should you review your insurances? So again, it's a difficult question in terms of exactly what's right for each individual. But the way we think about it is just major life changes. Insurance is a big part of your life, and it's really just about making sure we're mitigating any downside, issues, health issues, anything like that. We are covering that. So any major life changes, increases or decreases to your debt. So if you get an inheritance, you pay off $500,000 off your mortgage, amazing. Well, you actually may need less cover at that point in time. And the opposite is true. If you go and get a $1 million mortgage, you're going to need a lot more cover at that point in time. Change in family situation. So if you're about to go on parental leave and you're expecting a child, you may need to consider whether you need more cover or you need to make adjustments to your cover. And even if you have multiple kids, like, do you actually need more cover if you've got multiple kids? Depends on the level of cover you set up at the time. Changing careers. So generally speaking, if you get to a high risk career, if you're an accountant and you become a police officer, you won't want to change your cover because you're going to pay heaps more for insurance. But if you do the opposite, if you're a police officer and you become an accountant, then you want to consider changing the cover because it'll be cheaper for you. So increases or decreases to income. So again, a lot of the way we think about the cover is based on your income. So if you go and get a promotion, you're getting paid 50 grand more, we'd want to cover that increase. And same if you get paid a lot less, whether you go down part-time or whatever that looks like, you want to make sure we're covering the correct income. You don't want to be overpaying for insurance that you can't actually get claimed on. And then the policy anniversary. So, the policies generally have some features in there that every anniversary, if these life events happen, you can make some changes without going through underwriting. So it's always a good time just to review the cover and the level of cover if it's appropriate. Most common claims.
So we've got a list of most common claims for each gender and different age groups as well, because they often change as well. So to give you an idea of, what are most likely things that people do claim on when things go wrong. So if we're looking at with their life insurance, so if they were to pass away, what are the most common things that people are passing away from? Up to age 35, it really is a bit of a mix. So we're looking at 16% being cancer, 10% being cardiovascular, and 16% being accidents. We don't have the remainders. They're a lot lower, but the computer's lost streaming content, but I hope I'm still talking. With life for males between 46 and 55, rapidly rises for cancer, 42%, cardiovascular at 27%, and as you can see, accident injuries drop down to 4%. As you can imagine, a male up to age 35 is more likely to do something silly as compared to someone at age 46 to 55, we hope. So that is the main reason why that changes. Hope I'm connected again, Kim. Keep messaging people through and Phil can jump back on if I'm not speaking anymore. For females, as you can see, things for people, for females up to 35, looking at 22% of cancer and 45% of cardiovascular. And then again, jump again for 46 to 55, cancer increases to 71% of claims. So there are main areas for life cover. Critical illness or known as trauma that we've been speaking about. As you see there, again, cancer is one of the highest ones. So 65% for males up to 35 and 48 for 46 to 55. That's mainly because lots more other illnesses are more likely to happen at that point in time as well. Rather than the cancer decreasing in terms of its likeliness to happen, everything else is picking up as you get older. Similar to females, 60% up to age 35, but it also, again, jumps to 70 at 46 to 58 as well. Then we have our income protection. Very similar again for the males. Accident injury ranks pretty highly up to age 35, but nearly 72%. 45 dropping down to 45% between 46 and 55 because, again, males are likely to grow up over time, we hope, and do less stupid things. Other ones that most people don't think about is our mental health and behavioural one. So if you're having, different things that are keeping you out of work regarding your mental health, starting at 4% up to age 35, and then also increasing to 9% as well, which most people don't really think about mental health when they think of making an insurance claim. They're more thinking about physical injury, have a broken arm, and unable to go to work. Similar for our females, so accidents start at 40%, dropping down to 28%, and then cancer is the one that picks up a large sum of the percentages over time. Permanent involvement, very similar. Permanent 38% being accidents for males, down to 24% for 46 to 55, and as again, mental health really picking up later in life as well. For females, not as much in the accident space, less likely to do silly things, but 37.5% for up to 35. And again, still number one thing for 46 to 55, but dropping down to 24% with cancer picking up 18%.
All right. Pitfalls to avoid. So, Trent, you are a bit patchy. We'll keep pushing through. I actually had to make a phone call to see if our special guest is all sorted as well. So, logistically, we're working through some stuff, team. But we're going to do some pitfalls to avoid. So, what to avoid when setting up your cover or to think about. So, don't get your insurance from Koshi and the Cash Cow on Sunrise. Now, I don't watch enough Sunrise. I need some more Sunrise in my life. But the point of there are lots of ads on TV, no medical insurance. So, sign up, we'll give you a policy. You don't need to go through medicals. And they sound great. How good's that? You don't need to prove if I'm healthy or not. But the back end is claims, like how are they going to pay out on claims? Because if you got cancer, they're not going to give you cover, even if they don't do medicals, but they'll just have a clause in the contract that says, hey, we're not paying out if there's a pre-existing condition. So don't buy it online. Don't listen to Koshi. Love Koshi, but just don't go and buy really important insurance through the Cash Cow. Only increasing cover within your super fund without seeing if there's a better insurer out there for you. So as Trent touched on before, when he was talking about the different outcomes from insurance companies, they're not all the same. It is a little bit different to banks. Banks are generally you give or take 10% how much they'll lend you. They might dislike you if you're self-employed, but roughly they'll all give you money to buy a house. Insurance can be very different outcome. One insurance company will say, we'll give you cover without exclusions or loadings, and another might completely decline it. So if you just go through your super fund, they decline it, and you just put your hands up and say, hey, I can't get cover, that may actually not be the case because they're only looking at one insurance company. So it's definitely worthwhile looking at the market and seeing if there are better options out there. Setting your insurance and forgetting about it for years to come. So that's a pitfall. If you set up your cover when you're young, single, don't have any debt, and then 10 years later you've got a house, mortgage, you've got 3 kids running around causing muck like mine. Well, your need for cover is going to be completely different. So it's not just a set, forget, don't ever touch again. It's definitely something you should be reviewing. Saying I'll get that in the future. This is the big one in Australia. It's all a bit too hard. Life is busy, and we understand life is busy. But insurance is one of these things that when you need it, you can't get it, and when you get it is when you don't need it. So making sure you get it when you don't need it, and so you're not left without a safety net. And then the other thing I see a lot is people just not taking out any cover because it's all just too expensive. Insurance is expensive. Welcome to Australia. Everything's expensive. But the great thing about insurance, it's not I'll take it or leave it. You can dial down the level of cover. You can say, hey, actually, that's maybe too expensive for me. Can we halve the level of cover? So maybe I'm not covering my full income. I'm covering a bit less. Or, yes, I understand we should be covering medical expenses, loss of income, mortgage, but actually my budget says I can only cover the mortgage. Okay, great. Well, that's the good thing about insurance. It's just a dial how high up and how low you want to go based on your kind of own personal risk profile. So we'll see how you go here, Trent. I'll take over if you.
Yeah, hopefully I go through. So comparing a few things between superannuation policies, whether to hold them inside super or outside super, and what are we gaining or losing by doing either option? So having a policy inside super, what are the good things? Well, the first thing is looking at lessening. So if your super fund's paying for it, you're not having to pay for it out of your pocket, which for some people, depending on what they're doing in terms of family situation and one partner working while the other one's looking after young children, interest rates rising, that might be the best option at this point in time. The bad part about that is it's going to impact your retirement savings. If more money is coming out of your super, there's less money staying in there to continue investing for your retirement. So it's a give and take sort of option there. And there's plenty of things we can do to have some of your insurance through super, some outside super, or make those extra contributions to super to alleviate some of that risk. Next one we have is can be cost effective on default amounts. So if you have your super fund that has default insurance in it, so for the most part, opening up a super fund in Australia, that will give you a level of cover. Might be 100,000 of life and TPD. And then they might have a minimum income protection policy, which covers, for the most part, 20 or 30% of your income for 2 or 3 years. It won't be 3 years, but it'll be 2 years or 5 years. That usually is relatively cheap. So it might be in your best interest to keep that. But if you were to go ahead and go to that super fund and say, hey, I want to actually increase it to a level of cover that we think is the right one for you, covering your mortgage, the rest of your income, and all that sort of stuff that we've spoken about, it can often be really expensive with those super funds, and often more expensive than with this directly with an insurance company as well. On top of that, that default cover is usually has limited or no underwriting as well. So they give you that cover up front. As long as you don't claim on it, usually within 1 or 2 years, they don't overly care about those pre-existing health conditions you have as well. So for that client that we had previously that wouldn't be able to get cover, if going to offer a cover for the income protection and permanent disablement, we might look at saying, all right, keep that cover within your super fund because we can't get it elsewhere, which is often something that people will look at. Super linking our policies as well. So what we can do there is often pay for a lot of our features of insurances through your super fund, and then the features that we need to pay outside super. So there are a few that we need to do because the super funds don't allow you to pay for them. We can have just those features outside super. So we only have to pay for the things we need to personally, and we can pay for everything else via our super fund to, again, alleviate some of that cash flow issues. Other things in the bad column, claim time, tax and conditions of release. So often the case is with claim, you have to meet a few extra conditions of release for the super fund because the super fund will have different rules than what the insurance companies have. Often they'll match up, sometimes they don't. So there is a chance that sometimes your money from your insurances would get locked within your super fund until you meet those conditions of release. The other one is tax. If you are to withdraw money from your super fund early, so you're thinking if you become permanently disabled at age 30, 35, it's a long way into retirement. So your money from your permanent disablement is going to land within your super fund. Then you're going to withdraw that money so you can use it for covering your mortgage, covering your income up to retirement, all those sort of things. With that withdrawal comes tax. So what we do is we'll tell you to take out more insurances to cover that tax, which is premiums as well. Our limitation terms and conditions as well with our group policies. So as we mentioned earlier, all insurance companies are the same. So often the case is with your super fund policies, they will have different limitations on what is actually offered within the policy. And some of them are really quite restrictive. They don't allow you to continue getting your income protection if you've been paid out your permanent disablement, which for the most part, our calculation is mixing them together. So you're receiving your income protection through retirement and getting your permanent disablement, where some of them will say you get one or the other, you have to pick. And then the other one is we can't pay for our trauma cover through our super fund. So none of the super funds are able to offer it. So that's another downfall of just having your insurances out through your super. And we have a comparison between our group and retail policies as well. So I'd probably mentioned a lot of those things already, but we've got another slide on that. So the first one is our insurance option with the group insurance policies. They're actually done by an insurance company. So often a lot of the insurance companies will insure the same super funds that everyone uses in Australia. And they will often change in the future as they for the insurance every year. What happens is if we go to apply for insurance with that direct, we only have the choice of that one insurer. As we spoke about earlier, that insurance company might be one of those ones that actually decline your income protection and TPD. Where our retail cover, we're able to look at those wide 10 or plus different insurers and figure out which one's the best one for you, not just going directly to your super fund. The payment flexibility, so as mentioned earlier, we can have some of your insurances through super, some outside super with your retail policy. With your group insurance policy, that's always just going to be within your super fund. We're unable to add the trauma or the child trauma policies, where the retail policy gives you all the bells and whistles, allows you to pay sometimes through super for some features, and then always outside super for the other features and things that you want to pay for as well. Can your policy change in the future? So if you were to take out a policy with a group insurer, they can change your policy as they see fit. But if they were to change insurers, so they were to tender out to their insurance book to another insurance company might take it over. The super fund says, perfect, you're going to be our insurer. They come through and say, we don't want to offer insurance to these sort of people in terms of their occupations, or we're going to limit everyone's insurance down to X amount of dollars. So if you've increased your policy with group insurance, they can basically just cancel your policy at any stage they see fit. Where your retail policy, once your policy is signed and the contract has been submitted, your policy cannot be cancelled unless you stop paying your premiums. So the most common question I think I get from most meetings is, what happens if insurance companies go bust and go broke? What happens to my insurance policy? So for the most part, insurances, they have large capital requirements to run an insurance company in Australia. So there's that part. But if an insurance company wants to leave the market, they actually will sell their business to one of the other insurance companies. That policy will remain the same. So you won't be under the new insurance policies, new terms and conditions. They will be buying your contract that you have previously, and you essentially just be paying premiums to a new insurance company under the same policy. And the cost, it's always complicated depending on how much level of cover you take, the types of features, the benefits that we're looking for. There's so many different things that we can learn, we can use. So it really comes down to your need, whether you're happy to take out less cover and pay less fees, or more cover with all the bells and whistles for a high premium. It sort of comes down to your need.
Yeah, and also on that cost, the retail or group, it's like there can be heaps more expensive on the group provider, heaps more expensive on the retail provider. It's not one is cheaper than the other always. So misconceptions, let's go into this. So we've got 3 misconceptions. So myth number 1, the only way to pay for premiums via super is to apply for cover directly with that super fund. So one of the best things about the cover that we help our clients set up is we can actually get their existing super to fund the premiums with the choice of insurance provider that best suits the individual. So, my super fund may be with whoever the big super fund is in Australia, and their insurance provider may be TAL. Let's just name that. So Australian Super, they use TAL as the insurance provider. But I can set up a individual policy through any other insurance company, MLC, MetLife, whoever else, and I can still get Australia Super to fund that policy. So I don't need to apply for it directly with Australian Super. I think that's a big misconception. And also, I'll throw in another one, that it's always cheaper through the super fund. That is certainly not true. And 95% of the time, it's not true at all. Myth number 2, insurance companies never pay out claims. So we are going to touch a lot on claims. Trent already touched on the percentages and, the percentages of claims. But in terms of claim statistics, Money Smart website, which is an ASIC kind of funded public relations website, it's got statistics on claims, and you can select if I had insurance through my super fund, what's the claims statistics, and they'll give you a percentage of claims paid out per claim that's applied for, and that's over the last 12 months. So they give a 12-month window and they say what percentage of claims are paid out for life insurance, TPD, income protection, trauma, whether it's through super fund, direct to the insurer, or through an advisor, and it gives you percentages. And income protection's at 96% of all income protection claims are paid out. And life insurance, it's around that as well, 98 or something. Trauma and disability are a little bit lower, but it's a really high percentage. A lot of people think, they may not pay out claims. I'm paying for a whole bunch of money that I'll never get out. If it's a legitimate claim, you'll get paid out. And myth number 3 is the cover I can see in my super fund will remain the same. As Trent said, that's just not true. The super fund can amend that contract. At the end of the day, they're the ones paying the premiums, even though they're grabbing the money off you. They're the ones who are negotiating that contract. So as I said before, Australian Super and TAL, they'll renegotiate that contract every few years, and that can change on you. So we actually got this question before, Trent. So someone asked about, Aisha asked, are exclusions and loadings placed on my policy reviewable at all?
All right. So I'm going to slide back on this. For the most part, yes, they can be reviewed. can't see what's written there. Can often be reviewed in the future as your health changes. So if we're looking at a health exclusion, so our most common ones are mental health exclusion and back exclusion. We see them all the time with people seeking treatment for those two things. So often the case, the insurance company will say, you having ongoing treatment, or you have had ongoing treatment in the recent past, we're going to put an exclusion on that policy. So we're not going to pay you out if you would be unable to work or pass away or any of the other benefits, if those were to be the reason. So what will happen is, if you are symptom-free and treatment-free for a period of time that an insurer will set out, we can then have that reviewed. So for the most part, mental health is 3 and 4 to 5 years, depending on what your symptoms and treatment were. If you were to be 3 or 4 years symptom and treatment-free, we can go back to the insurance company and say, hey, my mental health is under control. I'm having no issues with it. Can I have that exclusion removed? We'll go to them, make sure that's all good, take that off, and then if your mental health was to deteriorate in the years to come, you're now looking at getting covered for that. So if you were to be off work in 4 or 5 years later after that because of a mental health episode, your benefits should be paying you out, as long as we've told the insurance company the truth and everything else around that. In terms of our loadings, so our most common loadings are smoker rates, which are built into the policy. There's a tick button that we choose. Smoker rates, you're more likely to claim if you're a smoker as compared to being a non-smoker. So it's not a term as such where they come back to you and say, hey, this is what it is. We do it at the start. So with smoking rates, we can have your smoking rates removed once you're 12 months smoke or vape free. So have a 12-month period. Really, you can actually go back smoking years to come and your policy wouldn't have to be re-amended, but you need to have a 12-month period where you are smoke-free, and that's just going to heavily reduce your premiums as you get older, because the statistics say that if you are a smoker for long periods of time, lots more health events are going to happen and the premiums really get driven up later in life if you are a smoker. And with our BMI, if you do have a high BMI, what they look for is a 12-month period of you keeping that weight off. So what they don't want to see people doing is going on a crazy yo-yo diet or having surgery where they have like a lap band surgery where they lose heaps of weight, but they haven't made a lifestyle. I want to make sure that it is a change in lifestyle so that your health and your weight is going to remain in range, rather than doing a crazy weight loss so your premiums can reduce and then revert back to previously what they would consider an unhealthy lifestyle. And then our family history as well will change on your policy. So typically what will happen is the most common one for family history is if your family members have breast cancer, what they'll ask is how old was your sibling that had that cancer or that disease? And what will happen is if they were to be age 40, 50, sometimes the insurance company will put an exclusion on your policy until you turn that age, or that isn't a hereditary illness that you're going to receive. So you might have a breast cancer exclusion on your policy up to age 40. And once you get over 40, they'll have that exclusion removed from your insurance policy, and you'll be again covered for that moving forward.
Cool.
We can review your policies. We'll find out from the insurance companies when you do apply, or if you do apply, and we will put in our calendar to get back in touch with you to do that, so that we can be covered for those things rather than having exclusions.
All right, just to touch on that last point, because we lost you for a second. So the family history, when you're applying for cover, they'll ask for, Trent was giving the scenario around breast cancer. How old was your mum at the time she had breast cancer? And that will have an impact on your application. And if it's within a certain range, they'll also be more comfortable to offer cover without an exclusion if you are applying for cover over a certain age. Different companies have different rules, but let's say you're over age 40 and your mum had breast cancer when she was 50 to 60, they wouldn't put a breast cancer exclusion on it. But if you're under 40, they might put a breast cancer exclusion. So just in terms of reviewing that cover, once you're over that age 40 limit, then they can potentially remove that exclusion. So you just cut out right at the end there, Trent. All right, live case studies. All right, so I've got 2 case studies. I'm going to breeze through these 2 because we've got a live case study. So one of our clients had breast cancer, young, female, single, 34 years old. I remember at the time she got paid out the claim. she was saying to me she really didn't think trauma was worth it. And I think it was $50 a month was the premiums. $50 a month is nothing to sneeze at, but when you factor in that she literally 4 months after she took out the policy, she found out she had breast cancer and got paid out $186,000 or $187,000 for trauma, and then just shy of $50,000 for income protection. It was really impactful for her. So this client took some time off work, actually wanted to work a little bit as well while she was going through treatment. And she was from New Zealand originally. So she was living here on her own without family. So she had the funds in the bank just to be able to fly her mum over, just to be around, help out while she was going through treatment. The next one was a client who found out they have MS. So 29-year-old female, married, $400,000 mortgage. What's going to happen to a 29-year-old? Nothing really. So it's kind of a waste of money. But she found out that she was having some sight issues, and then went and got tested, tried to work out what was going on, and found out that she's actually got MS. So she did have income protection because she did take some time off, and then her sight came back and recovered. So she is back at work. But it depends on the MS. If it's stable and very stable condition, which a lot of people can live with MS for a really long time, then she won't get a trauma payment. But if it does deteriorate, then she's still got that trauma policy. And if she didn't have cover and then went to apply for cover, she would get declined outright because she's got MS. So we can't make any changes to that policy, and we're not going to be able to easily increase it. There are some tricks that we can do, but it means we've got that policy for a long term, and it's really important to maintain and keep in place if her health does decrease. Now, the next scenario is we've got a close friend of mine, Jason Milicessi. Can you come on stage? Got to click
Come on down.
Come on down. Are you here? You got to click a button, Jace. I don't know what the button looks like, but as we're trying to work it out,
it's the far right
maybe Trent can give him a call. No, here he is.
Yeah, here he is.
And turn your camera on. Here we go.
Hi.
So just the intro, Jace is a close friend of mine. Earlier this year, he gives me a call. We've had many phone calls, and I've been very blunt and abrupt with you many times, all out of love. And this phone call started with the same abruptness of me telling you off for calling me when you should be on holidays with your family. But yeah, what was that phone call?
Yes, hi. Thanks for having me on, Phil, Trent, and Team Sky. Good to see you guys as always. That phone call, so it was back in Jan, before the working year officially started. I was on holidays, as you just said, Phil, and I called, and you probably saw me calling and going, "Oh, this he's just been a pain in the ass BDM. He wants to get on the front foot and get more sales out of me." I wish that was the reason for the call, but the call was to tell you that a few days prior to me calling you, I'd been diagnosed with stage 4 pancreatic cancer. So, that particular week, my world was flipped upside down, and it was a diagnosis that literally hit you for six. I was not expecting that at all. So, yeah.
So, thanks for coming on. We spoke about you coming on ages ago, and they called you up yesterday and said, "Mate, I'm assuming you're not going to be able to come on, but let me know." So I appreciate you taking the time out of your time with your wife, watching Netflix and hanging out and chilling out on the couch. So appreciate you. The reason I wanted you to come on is because we've always been very cautious at Sky, making sure we never sell insurance out of fear. Like, we don't want to be fear mongers. We want everyone to make a very informed decision about what's best for them. But at the end of the day, when the rubber hits the road, like, these things can happen. As you said, stage 4 pancreatic cancer. You're 42.
At the time, yes, I was. Yep.
Now you're old. You're 43.
Now I'm old. Now I'm 43. Yeah, thanks. Yeah.
You've going to the gym 5 days a week, two young kids. Like, you're the last person who would think who would get cancer. And we, Trent and I, we sit in front of clients all day, every day, talking about it. And the amount of times that I hear people say, I'm young, I'm healthy, I look after my health, I eat healthily. I probably don't need some of these insurances. And we respect everyone's decision. It's an informed choice that they're going to make. But the reason I wanted you to come on is just to kind of share your experience, as much as you feel comfortable, but also even just talk about like, how's it impacted your finances?
Absolutely. Yeah. I'll go back a step, Phil, quickly, and just the whole thing of it won't happen to me and what do you need insurance for? I'm a living, breathing example that life happens, and sometimes in life you expect the unexpected. Yes, as you said, fit guy, gym 5 days a week, walking 15,000 plus steps a day, eating well, fit as a fiddle. So being diagnosed with something like this was the furthest thing from my mind, but it happened, and I'm saying that. So unfortunately, sadly in life, sometimes the unexpected does happen, and we need to be prepared for that. And thankfully, I had the cover in place, which you guys reviewed for me and made sure I had all the appropriate levels of cover in place. But I haven't worked really properly since January, Phil. I stopped work in January when I found out. I only recently returned to 1 day a week in August, so a couple of months ago. And I've really only been able to do that because I had insurance cover in place, because I had that financial buffer, which allowed me to take the time off, not worry. I mean, I've got a young family. I've got two boys, a 10 and an 11-year-old. My wife, Bess, she's a stay-at-home mum. And thankfully, I had the cover, which has allowed me to take the time off work, focus on my health. At the same time, it's taken the financial stress away from us as a family as well, because you came into the picture very quickly when you found out about my diagnosis as my financial advisor and friend, and you made sure that the insurance company that I'm insured with paid out my trauma cover fairly quickly, and I was lucky enough with the type of income protection contract I have that I got 6 times my monthly benefit paid up front in addition. So that was a huge relief, because, as I said, we didn't have to, Bess and I didn't have to worry about how are we going to pay the bills, how are we going to cover the mortgage, the kids, what are we going to do? We've been able to, as I said, take care of all those things, and still I've been able to have the funds there to fork out for treatment and other things needed for my current ongoing battle with the disease.
Yeah, and it's one of these things, like, I'm not going to ask you about your personal financial circumstance, but like most Australians, we don't just have like $100,000 buffer sitting in an account ready to go if this happens. Like, and I've, if I was better prepared, I'd pull up your policy schedule and work out how much your trauma premiums are, but it's probably, less than $50 a month. I'd probably have a guess. It would have been, Trent reviewed it recently, so he'd probably be able to work it out. But it's not expensive for trauma. Income protection, that's more expensive. There's definitely much more expensive. But that also, it helped us understand that as well. So you got 6-month income protection, you got your trauma payment, but then also, what has it been like? Is that it? Is that all you've gotten, or has there been something else?
No, so I've had in terms of insurance, I've had the trauma and the IP. And now 6 months. So 6 months from diagnosis passed, and you were there to then speak to the insurance company about commencing my monthly benefit, my monthly income protection benefit, which has since now been going since August, I think, was the first monthly benefit that came in. So no, the trauma payment, the trauma lump sum, and the 6 month, monthly benefit that were paid in January it didn't stop there. I'm now getting a monthly benefit, which is substituting an income for me, because my work capacity has reduced significantly. As I said, I'm a day a week, and that's as much as I can do. So again, that's eased the stress on us, because there's that monthly benefit coming in every month, which is easing any financial pressure and stress from us, and it's ensuring that there is that continuous buffer there for my medical stuff, for my treatment, for seeing some of these oncologists and specialists ain't cheap. Let me tell you, they're pretty expensive. Some of these guys, So we've been able to do that, and again, I can continue to focus as much of my energy and strength that's needed on my health, physically, mentally, and battling this, and not worrying about, oh shit, I've got to get back to work. I've got to up my hours. We're in strife fest. How are we going to make the next mortgage payment? The kids, what are we going to do? School fees. That hasn't come into play, thankfully, because of the cover.
And you got high school next year?
One more year, buddy. So Christian will be
okay.
grade 6 next year, and then he starts in 2025.
Yeah. I mean, I know I don't want to take up too much of your time, so you let me know when you need to go. But the other question I have is, like, mate, you look healthy. Can't you just go back to work?
That'd be nice. Everyone says I look healthy.
It's not like you're working a highly physical job either. You work in an office, so that's what often I'll get the question is, I cannot go back and work that. That'll be easy.
Yeah. It's actually, I'm glad you guys raised that point. So thankfully, I look okay, considering what I've been through. The body's held up well somehow, but to answer your question, boys, with the type of role I have, it's quite mentally demanding, and you need to be on. And as you guys can imagine, going through what I'm going through, I don't have the same mental capacity that I once did, and that's the reality. To be able to get out there and present on products and meet with new advisors, train new advisors, put out any spot fires for my top existing clients whilst they yell at me, and just things like that. The reality is, though, I don't have that same mental capacity that I once did, because it's just overloaded with all this other stuff that I've got going on in the background. So, and on top of that, the chemo, boy, does that knock me about. So it really takes it out of me. It'll zap me of all my energy, all my strength for about a week. I'm doing it every fortnight, and it's pretty demanding on the body physically, but it's also demanding mentally. So no, there is no way I could do what I used to do.
And again, talking about these misconceptions and claim stats, like, a lot of people think, well, insurers are trying to look for any way not to pay. And as I said, you look healthy, you sound healthy, you sound great. Like, you literally sit at a desk and send some emails. Like, it's not, not that hard of work, professional work. But the insurance company have never once questioned your ability to go back to work, and never once said, actually, Jace, you're probably fine. Come on, mate. Go, head back to work.
Yeah, no, they haven't. That's right. They have not once questioned it. The income protection monthly benefits, Phil, Trent, that I'm receiving, you guys know, the process there is really they check in every 3 months to see how I'm going. Has there been any change to my condition, any improvement, or have I gone backward, or am I kind of just plateauing the same? And they get that. They go to my GP for a review and a letter to see how I'm going. The claims assessor's called me a few times and how am I going? And I've just basically what I said to you guys. I said the same to him. The chemo knocked me about. Pretty fatigued, pretty tired. Some days are better than others, but they've been really supportive. They've been really, really supportive. Every payment that they've said they're going to make, they have made, and it's been on time. and it's been the amount that they promised. I really can't fault them at all.
Yeah.
So,
Yeah. Mate, I appreciate you coming on.
I'll just say having you guys there as advisors in the background too is obviously imperative, really important for anyone out there looking to get insurance cover. Please get a financial advisor and don't look past these guys at Sky because they rock. They're awesome.
Mate, I didn't even pay you to say that. I need to get out the checkbook now. Are you kidding me? That cost me.
I'm going to send you the bill later separately via email.
Mate, I appreciate you coming on. As I said, there was, there was no expectation to come on. I think it's really important not to sell fear when we talk about insurance. Like that's not what we want to sell, but we also want to talk about reality. Like reality of the fact is you were earning big bucks. I know what you were earning. You were earning big bucks. And this wasn't working. You got 2 young boys at home, and in an instant, your life turned upside down and you haven't worked for almost 12 months and no plan to go back full time in, anytime soon. Like that's not even a reality in the near term future. And so that's really like, when we talk about claims, statistics, talk about percentages, talk about all these things, at the end of the day, it all doesn't really matter about the percentages and all these numbers. It's just about real life cases. And yours is, from a personal level, we know each other. Like I was a little bit unsure if I'll cry bringing you on here, but fortunately I've kept it together, which has been good. And so your scenario where you've been able to stay strong mentally, but, knowing that there's insurance there, knowing you can work 10 hours a week and it not impact your income protection, all of these factors that, just to be quite frank, doesn't actually happen without you, forking out the money at the very beginning, saying, yes, this is important to me. If something happens to me, I'm earning a decent wicket and I need to look after my family. So we're paying these premiums. So yeah, thanks heaps for coming on today.
No worries. Thanks so much for having me, Phil, Trent and Team Sky. Great webinar, and no doubt we'll speak soon.
Thanks, mate. Appreciate it. All right. So what we're going to do, we're going to go into Q&A. Once again, just want to thank Jace for coming on. It was yesterday. We had a very good discussion about his capacity, and he was saying no, probably not. But then today he's like, I really want to help you guys out. You guys, he just believes in what we do, and obviously it's had a huge impact in his situation. But let's move on to Q&A. We're going to ask any questions. If you've got any other questions, please just chuck it in now. We are at the end of our time. So if you need to go, you got to put the kids to bed or, do whatever you need to do. Go and watch something on Netflix. Go and do it. But we're going to do Q&A. We're going to try and do one-on-one, depending on how stable Trent is. So Trent, do you want to try and answer this one?
I can answer the first one. So the question is, if you're suffered an injury at work, why get income protection if work cover can do that? So if you want to go straight into what we just spoke about at Jace, that is one of the key reasons why he's had a major illness that isn't going to be work-related in terms of it happening at work. That is one of the major things we're looking to claim on. Also, with your work cover, if you're never able to work again, there is chances, depending on what your work cover looks like, that your work cover only covers you for 2 or 3 years, maybe 5, maybe 10 years, where our income protection and everything else we're looking for is covering you through to age 65 for the most part. So we want to make sure we've got that longevity. It is playing with fire a little bit, just relying on your work cover, because you spend less than half your time at work. There's lots of other things that happen outside of work, especially regarding those massive illnesses that, we've spoken about.
Yeah, we'll put on these claim stats. Like you can see, like mental health is a big one. Just for males under 35, 20% is mental health. Like the reality is most of those mental health claims are not work related as well. So work cover only covers you if you injure yourself at work. So Aisha, I'm young, healthy, no kids, mortgage. Why do I need personal insurances? Again, let's touch on this. These claim stats, injuries and accidents do happen. My philosophy is if you've got an income, then you should be protecting it. Now, if you don't have an income, don't have debt, don't have dependents, you're just living off, the bank of mum and dad or whatever that looks like, great, no need for insurance because there's no loss if you weren't able to work. But I know, even when I was pre-kids, pre-marriage, there's no way I want to live with my parents for the rest of my life if I'm injured. So at the very, life insurance, you're right, you probably don't need that. But the other covers, these things happen. That claims experience with that client, I got to keep on remembering not to say their name. I keep on just going to refer to them personally. That single, no mortgage, breast cancer. And so it does happen. You don't need kids for it to have a massive financial impact.
All right, let's go to the next one, which is a bit of a juicy one. Who sets the standard for insurance companies? Are they regulated by government legislation or primary industry pressures? So I actually don't know. They do have a government body that looks after them. Is it AFCA that looks after them?
APRA is the regulator who sets all those. Like Trent talked about the capital requirements. So insurance companies, they need to set a whole bunch of money aside. That's regulated by APRA. So APRA needs to make sure that insurance companies are stable. There are there's a whole bunch of legislation regarding every kind of industry, but that's the main regulator. How does discrimination come into this?
Yeah, so it's one thing that it's a bit strange, but insurance companies are allowed to discriminate based on your previous health conditions, your family history, things like that. Reason for it is they don't want people that are looking like they need to claim and going, all right, I need to go get my insurance today so I can go to the doctor tomorrow and say, oh no, I've got cancer. I've taken out $500,000 of trauma. I'm going to get paid out my trauma claim. It's really the only way they're able to make sure that we're not getting policies that you shouldn't be getting and people taking advantage of the insurance system. So as far as discriminating, they're not discriminating against race, gender, those sort of things, although your gender will play a part in the level of cover or the premium of cover. But in terms of, the typical discrimination side of things that most people will see as being bad, they're not doing those sort of things.
Yeah. So, legally speaking, insurance companies are allowed to discriminate if it's backed up by statistics. That's, if you've got a car and you've insured your car, when you insure your car, you need to say, where are you housing the car? Do you have a carport? Do you have a garage? And because that'll change your premiums. Are you driving, 5,000 kilometers a year, 10,000, 15,000? Because you're on the road more, so you're more likely to have an accident. So that'll change your premium. So when you're getting car insurance or really any insurance, we understand that premiums will be impacted by a whole bunch of factors. It's the same when it comes to personal insurance. All these factors have an impact and they have a premium impact. So legally speaking, insurance companies, they've got an exemption under discrimination law. But as long as it's backed up by statistics, they can't just say, oh, we don't like you, Trent, because you've got, big ears. There's no statistics that you're more likely to claim. And Trent, you don't have big ears. It's okay.
Your little ears. What have we got next? If I already have policies within my super fund, what's the process of getting the retail upgraded policies? Will the advisor cancel my existing policies? So it really depends whichever financial planning firm you go to, really, and what the advice is. So for the most part, at Sky, we will often keep a lot of those retail or the group cover insurances within your super fund if you have exclusions or exclusions on your new policies. Some advisors will go ahead and cancel those policies for you if they think it's in the right in your best interest to do so. At Sky, we actually get you to do it for us. So we'll set up, if we think it's in your best interest, we'll say, perfect, your new retail policies are set up. You can go ahead and cancel that policy with super or any other super fund because we're now covered you through a retail policy. So it really depends on what sort of advisor you're dealing with all for you and really be hands-on. Other advisors will get you to be involved in the process and collecting data and things like that as well.
All right, next question from, I don't know how to say the name. Trent, do you know how to say this name? I'm really sorry.
I'm going to say Cadeau.
Cadeau. I'm sorry if it's not how I say your name, and we've just All right, are there certain coverages that may be less important at this stage, especially for young people? So it's a difficult one. Like for me, young, assuming single, assuming no kids, no mortgage, life insurance is the least important. When you got kids, you got a mortgage, life insurance becomes the most important. But for me, income protection is always the big one, the big ticket item of making sure you've got, because your income, everyone's got wealth goals. Hey, I want to buy a house, or I want to, start a family. Like everything anyone wants to achieve in life requires an income, or someone else to have an income to pay for it. So that's why income protection is very, very important. The other ones are just a matter of going, okay, what's more likely to happen? Well, trauma is more likely to happen, but it may not be as financially severe. TPD is less likely to happen, but it's incredibly severe if it does happen. So it's pros and cons for all of it. I like to, my preference is take them all, but if you can't afford the full amount, then just dial back on it. But yeah, life insurance in that scenario is probably the least important, but also I'll quickly brush over it, but life insurance, you can often add it. If you're taking out the others, you can often add it, and almost doesn't cost you anything sometimes.
Awesome. So might be unrelated, but are there specific insurance products or policies that can enhance the overall superannuation strategy for someone starting their career? So I'm going to take this a couple of different ways. In terms of insurance policies that allow you to make extra contributions to your super fund or have investment options within the insurances was not really something many insurance companies have them these days. So those insurance policies are actually called whole of life policies. Usually they were typically sold in the 90s and they actually weren't very good. But in terms of your superannuation and your insurance, that can also be a massive effect. So if you have your insurances within your super fund, you're probably going to have to keep that super fund there. So Australian Super Investment, Australian Super Insurances policies. In the future, you might say, all right, this super fund I have now isn't the right one for me anymore, and I want to put my investment with XYZ super sustainable, or they're investing more, or whatever it is. If your insurances are with that super fund, you're going to have to cancel that super fund to move all your super across, or you may need to keep a minimum balance, or you might have to keep that super fund in full. If you set up your insurances, say through a retail fund, we can then move your super fund in any way we want. All we need to do is say, hey, our insurance with the retail fund, paying via our move our fund from super fund A to super fund B. We just let the insurance company know, hey, this is where my super is now. Can you please take the annual premium from this super fund in the future? So it gives you that flexibility of where your super fund is in the future, and yeah, maintaining where your investment is, because that can often change in the future as well.
And also, like, superannuation has a big impact on insurances. A lot of insurance is funded through super. It can be more tax effective paying for it through super. So yeah, super and insurance, they are just intrinsically linked, purely because legally speaking, super funds have to consider the insurance needs of all their members. That's just a part of their obligations as a super fund. Right, I has asked the question, not myself, someone named why isn't trauma insurance able to be done through super? This is just a part of legislation. Legislation says that you cannot own a insurance product and pay for it through your super unless it meets the condition of release. So, if I go and have a heart attack, don't have any time out of the workforce, go into emergency, get stitched up, all good, out of hospital in a week's time, I can go back to work. Well, under the superannuation legislation, I can't take any money out of super under that regard. So the super fund can't pay for an insurance policy that I can't access. And so that's why trauma can't be funded. It used to be before 2014, and then they got rid of it in 2014. So old policies, they can still be funded through self-managed super funds, but almost no one we see's got that. So.
Awesome. Do you want to bring the presentation up again for this one? If I work as a lawyer, is there an insurance company that would be good for my type of occupation? So your occupation is one of the 6 or 7 things that we look at. It isn't the first thing. So we'll often look at your health events and your pre-existing health and your family events first to make sure, all right, there are certain insurance companies that have better occupation rates, better premiums for certain occupations, and lawyers is one. But that insurance company might say, we're not going to offer cover because of X, Y, and Z health event. That sort of knocks that out. So our first point of call is your pre-existing health. Then it's the range of the levels of cover, our types of premiums, the features and benefits in our occupation, all mixed in one. So basically 3, 4, 5, and 6, we all sort of work together after we've worked out what 1 and 2 looks like. So it does play a part, but it's definitely not the first thing we look at.
Yeah, a lot of people who, you know, talk to their colleagues, oh, what insurance company do you go with? And it may not be appropriate because of the health conditions. But there is a company, the one Jace works for, that does specialize in certain occupations. All right, next question. All right, also, are there trends or changes in the insurance landscape that we need to be aware of or might impact our insurance decision, and how does personal insurance or planning around that tie into overall financial planning? Like, what are the common mistakes a young person might make when starting this or sorting out their financial security? So are there any major changes with insurance? No, all those changes were done recently. There's not really any upcoming. There is kind of one that's outstanding that was kind of on indefinite hold. I don't think that'll come in. There's nothing really massive moving forward. The only thing is that your health history, you don't know what's going to happen in the future. Jace, definitely this time last year, there's no way he would have thought that he was going to be off work for 12 months. Every client that goes through a claim, you know, no idea that this was going to happen. One of our team members actually just got paid out $240,000 for an insurance claim herself. 6 months ago, if you told her that she was going to have that money in the bank, she would be gobsmacked, because sure, some people get an idea, but you can't predict that your health history or your health future, I guess. So that's really the thing that I think about is if you've got cover, like that client I touched on who has MS, like now she has MS, a diagnosis, she cannot get insurance moving forward. There's no one will offer a new cover. And she's 29, got a mortgage already. So that's the thing I like for young people to think about a lot is you don't know what's going to happen in the future. You may as well just get some cover set up now, just to protect that, you know, what if.
What is the base and requirements for trauma insurance claim to be paid out? Do I just need a diagnosis or be completely off work to that diagnosis to get the lump sum of money? Trauma cover works on diagnosis of illness, not based on whether you can work or not. So for Jace, being off work, didn't have based on the diagnosis. So each illness has different levels and all medical terms that basically a doctor can do the tests they need to and make sure that they're seeing those levels of illness as well. So I don't know the ins and outs of it all, but it is relatively straightforward for a doctor to say, yes, you have this illness to this level, as compared to, say, a permanent disablement where a doctor's saying, are you able to ever work again? And that's a more of a maybe question, yes, no. Are they willing to put their name to it until you get to a really severe level of illness where a trauma illness is, have you been diagnosed with this illness to this said level? Usually a relatively severe level still, but it's not to that permanent disablement like a permanent disablement policy is.
Yeah, trauma is a very, like for Jace, we just got the biopsy results of the cancer, and then they paid out straight away. A team member, same thing. We just got the biopsy results, so they're generally pretty straightforward trauma claims. Do we charge a fee? So do you guys charge a fee to help people set up insurance? Yes, we do. We charge a fee to go through what we call an insurance proposal. And so, which is basically, you know, this slide that we're touching on. So we ask you a million questions up front. We want to know everything about you, and then we'll go and do all that research. And to do that, you know, unfortunately, the team don't work for free. We've got to pay them. So we also charge people to do that work up front. Then we do a recommendation and we go through an hour meeting with the advisor, either myself, Trent, or one of the other advisors in the team. And we talk about the research we've done, the recommendation we've made. whether whether at that stage whether people go ahead or not with the insurance cover, that's totally up to them. As I said, we have people who say too expensive, don't want to go ahead, and as long as they're making an informed decision, we don't, we basically let people make whatever choice they want. But yeah, we charge a fee up front, and then to fund us to do that initial work. And then if they do go ahead with any insurance cover, we get paid a commission from the insurance companies as well for the additional work for applying for it all.
I'm going to actually answer the next two questions in one because they sort of relate to each other. So the first one is, if you do get a work claim through work, will it affect your income protection and permanent disablement claim? The second question is, what's the typical percent of income protection cover, and what percentage of income does that cover? What's the maximum insurance companies would be prepared to offer? So there is a range. For the most part, at the moment, insurance companies are looking to offer 70% of your income, plus your super as well. So looking at, for the most part, 70% of your income moving forward. Some will do a little bit more, some will do less, but the 70 is around the middle. There's not any in the Australian market that cover up to 100% anymore, unfortunately. They haven't done that for quite some time. In terms of the work cover claim, your income protection would be affected by your work cover claim. So if you had a work cover claim that is paying 70% of your income protection is also not going to pay 70%. So you're not going to get 140% of your income just because you have two policies. It's exactly the same. You have two income protection policies. They're not both going to pay you out full just because you're paying the premiums. So typically what an income protection policy will do is we're going to pay you out up to 70% of your income, offsetting it against other funds that you're receiving. So whether you're still working and you're working a certain amount of time, so if you're still able to do 20% of work because your illness is just deteriorating, similar to Jace, but let's say you're working a little bit more, the income protection policy is going to reduce your benefit by that amount. Or if you're receiving work cover, they'll reduce it by that amount as well. So the maximum you're ever going to receive is, for the most part, 70% of your income from your work cover or your income protection. In terms of permanent disablement claims, typically they're fine because that's a lump sum and it's not an income ongoing. If you were to receive a lump sum from your work cover claim, most of the time your permanent disablement pay you out as well, just depending on what level of cover. If you have really excessive levels of cover, they may look at living it, reducing it. But yeah, for the most part, we don't see any reductions there.
All right, Aisha, thanks heaps for all the questions, Aisha. I see you. Good job. So, will the advisor consider affordability of premiums based on my financial circumstances? Yeah, every client we see is their own special little butterfly. There are so many things that factor in. So pre-existing health, occupation, age, level of cover, length of cover, likelihood of keeping it, and also your income and your capacity to pay. There's no point us saying, hey, your income's 50 grand, but your premiums are $20,000. That's just stupid. I've never seen a $20,000 premium that I've put in front of a client, but under that example, we do consider affordability. So the way we do it, I don't know about every advisor, but the way we think about it is we think about it as percentages of your income. So we have that in the proposal document where we say, hey, it's our recommendation is to pay premiums through super and through your cash flow. This is how much of a percentage of your super contributions will go towards this premium. We recommend you put over and above that into super to cover that cost. And this is how much it will cost from your bank account as a percentage of your income. And then it's a conversation of, are you comfortable with that? Yeah. If it's not enough cover and you want more, it's going to increase those numbers. But if it's too expensive and you feel like you can't afford it, great. Let's work on a solution on how to bring down those premiums. All right, we've got more. Yeah, one more.
To answer your question as well, Phil, on the 20 grand premium, I've seen two. That's all I've ever seen. So they both earned over $800,000, and they were a lawyer and a high-end doctor. So not very common that you see premiums that high.
We're in the wrong occupation, if I understand it.
Our last question that we have here is: would the 70% of income based off your income protection be based on 48-week year if you're casual or day contractor? So when you're taking out your insurance policies, the insurers will look at your how you earn income, whether you're a casual contractor, full-time employee, self-employed, and that will affect your ability to actually take out your insurance policy at times. Insurance companies will go, if you don't have a long-term history of being a casual employee, say you've just taken on a new role, they might say, we're not going to offer you income protection because we don't know if you're still going to have that role in 6, 12, 18 months' time. But let's say your policy is enforced. You're a casual contractor. What they're going to do is work out at the time of claim, whether that's today or in 5 years' time, at that time, they're going to look at what your 12 months upon your being unable to work. They're going to look back and say, how much have you earned? We're going to pay you a maximum of 70% of what you've earned, or up to what you've actually earned, either, whichever is less. So income protection policy is paying you 70% of $100,000. Last year, you only made $50,000 because you're a casual contractor, you've gone on a holiday, you've taken time off work. Insurance company's going to look at it and say, you're covered for $70,000, so 70% of 100, but you've only made $50,000. So we're only going to pay you 70% of $50,000 instead. So it is one of the things that we need to maintain and be on top of in terms of your income. If it is fluctuating and if you do have loss, we are making sure that your income protection is still the right thing for you in terms of the right levels, because at that point, you're actually paying for a policy that you're unable to claim on. So if it is going to be a short-term thing, we might say, all right, let's just keep it and continue paying it so we don't need to go through underwriting again. But if it is going to be a 50 grand drop for longer because you're working less, you're staying home with family, those sort of things, let's figure out what your position actually looks like there. Do we need to increase cover elsewhere to cover that shortfall that you were increased for your permanent disablement, your trauma, or your life cover?
Cool. You just cut out slightly on my end when you gave a really critical number, but just to reiterate, when they look at 70%, it's at claim time, they'll look at 70% of your income over the last 12-month period. And so, yeah, that's how they consider it. There are a lot of nuances with that. Like if your income fluctuates a lot and drops quite a bit, they may look at a longer period of time. That's really a bit nuanced with the actual contract, depending on the insurer, depending on whether you're insured through the super fund or not. But yeah, definitely reach out. If you've got an advisor who set it up, reach out to the advisor and ask them how it works. If you've got insurance through super fund, reach out to the super fund and get the insurance guide, because that insurance guide, and as we've talked about, will change over time. So reach out, read the section of the PDS. Basically, how much will I get paid out is kind of the phrase that they'll talk about when it comes to claim. So just go to the claim section, and they'll clearly spell out how they'll assess the payment for that. Oh, last minute question. Cheeky monkey coming in. All right. In the case of claims, does the advisor through Sky Wealth help with the process? Coming in hot. I like it. Yeah, we help our clients with the claims. We've yet to charge anyone a fee for claims. That's kind of our commitment to our client, but that's not to say we never will charge a fee. A lot of our claims have been trauma claims, which it's easy. A trauma claim is easy from a work capacity point of view. Short-term income protection claims, but we haven't done a life insurance claim, thank goodness. But we may end up charging a fee for the time for things like TPD that can be really long and drawn out processes and can be a significant amount of work, or long-term income protection. We basically say, we're fair and reasonable. If we're going to do a crazy amount of work, we may need to charge you a fee. But yeah, we help through that claims process. But yeah, so that's kind of our process. Thanks for the last minute question. Appreciate it. So if you've got any questions about insurance, whether you got insurance set up, so I'll go right to the end here, but if you do want any help with your insurance, that's what we do. We geek out on insurance all day, every day. So feel free to reach out to us, even just booking a phone call with one of the advisors. Go to that link or QR code, I guess, and that'll book in a link with one of the advisors. Even if it's just a general question about your insurance, we can't obviously say, yeah, that's a bad policy or that's a good one over the phone. We'll need to do a whole bunch of research if you want, like concrete answers. we're happy just to have a chat just about your cover. We understand insurance is complex for most people. It's not something we wake up and think about. It's not very sexy. So people aren't researching about the most exciting insurance provider out there in the market. So that's what we do all day. So if you do need help, feel free to reach out. And then the next thing is we do love feedback, good, bad, or otherwise. If you hated the webinar, let us know. If you loved it, let us know. Give us feedback. We definitely take it on board, and we try and run these webinars every second month. So if you want to hear about our upcoming webinars, this is our last one for the year. But yeah, we love feedback. So please fill out that form and give us some feedback. Thank you for anyone who stayed around. We are 26 minutes over. So I appreciate it. Thanks heaps, Trent. Your internet has been patchy, but we got there for the most part. So I appreciate, everyone hanging around.
Internet's been patchy, but I've been pretty strong. My morale's been strong.
That's it. Internet's been patchy, but the content's been fire, my friend.
Yeah.
So that's good. All right. Awesome. Thanks, everyone. Have a great night.